Well, look at all that paper. It looks like my office, to be quite honest. Probably looks like yours too these days. And we're going to be talking about plan selection. Factors important to business owners are, first of all, they want to have tax deferral or minimize the taxes they have. And tax deferral is great. Uh, they want to watch out for themselves, quite honestly. They want themselves to be able to sell it if they want to. If they want to also have it protect their retirement, and they want to also, if they die, be able to help their relatives. And finally, they want a low personal risk. And I think that's valid for any business owner. Again, we're talking about small businesses. We're not talking about Ford or IBM. We're talking about Lee Shoe Financials, maybe a small company of a few employees, maybe one employee, maybe 20 employees. And sometimes the companies grow, and they still tend to have it safe when they want to sell it, when they want to retire or for death. The business objectives for the owners are cash flow needs, and that becomes a big issue for those who have retirement plans that require a lot of payments, such as a well endowed defined benefits plan, or maybe a contributions plan where they're putting in a lot of money. They want tax benefits. They have administrative issues that have to be resolved in case, how much are we spending administratively to do this, and how many employees do we have to tie up to have their retirement plans. We want to use it to retain key employees, and if key employees don't want retirement plans, probably we shouldn't have one. And so I have to really get to key employees what's important to them. I had one case where I had a small company. We had 3 full-time CPAs who worked for me, and they were all older. They basically had what they needed for retirement, and they were in semi-retirement, quite honestly, because they only worked 30 or 40 hours a week, which is low for an accountant. And when I mentioned that we want to set up a retirement plan, they would rather have cash because they had already arranged for the retirement plan. And other than accountants and maybe engineers and hopefully financial planners, people don't plan very well for retirement needs. For some reason, accountants and engineers are pretty good at it. And then employee morale is another thing, because it helps employee morale to have a retirement plan. Now, if all your employees are 18 or 20 years old, they don't know what the word retirement means. They want to see cash and benefits. So I think I'm better off giving them an iPad than to give them a retirement plan. They would be much happier. Now, if your workers are in their 30s and 40s, they have a better appreciation of it. Defined benefits versus defined contributions. The advantage of defined benefit plans are great build-up for small business owners. And so if you own your own little business and you have a high turnover of employees, so that none of them are there for longer than a year or two at a time, they're constantly turning over, I can build up a nice retirement plan for myself and my family members who work for me. Senior staff with longevity benefits. Again, many of these plans are based on salary and longevity with the company and age, so that you have staff of people in their 50s and early 60s. That's very attractive to them, because the way these plans are set up, you've got to stay with the company until retirement to really gain money out of it. And then for people who want lifetime employee benefits, then in other words, they're going to stay with the company as lifetime employees, and there's a greater benefit for those. Unfortunately, I don't know too many people today who've been with the same employer from the time they got out of high school or college until they retired at 59 or 62, whatever. In fact, just the opposite. For many years, the average employee out of college or school changed jobs within the first 2 years, and usually then the next one was 7 years thereafter. So that really they're in their 30s before there's any thought of even how long should stay with an employer. And other problems we have today is employers are changing the benefit plans, they're stopping retirement plans, they merge with another company, and the new company plans are different or may not have a plan. So there's a lot of things can happen. Defined contribution advantages, and I'm going to say first, what I think is most important is you can take the money with you when you leave the company and transfer to an IRA or to a new employer. And that's number 2 on the list, but to me it's so important that your clients understand that. And the first point we list here is little employer financial involvement is possible, which is good for the employer. And in many respects good for the employee too, because I feel that if you get it free from somebody, you don't appreciate it. And the example I'd like to give is if you give a child that's young, say 5 years old, a bicycle or a scooter, they'll have it for a week or two and then they'll probably lose it. Where if the kids have allowance they're earning and to get the bicycle and they've got to set aside the allowance, that bicycle is going to be given to their kids or maybe even their grandchildren. We have a much more involvement when we have to pay for it ourselves, and that's been true in all of the studies on retirement planning, that the more the employee puts in, the more the employee is conscious of it and uses it. People get it all paid for by an employer, many times don't even pay attention to it, and quite honestly don't even realize it's vest. And the next point here is employees who, it says young employees, but it's actually any employee who job skips after vesting can take the benefits with them, and as flexible as the criteria who can benefit, and that can be benefit for the employer and for good employees. The new compatibility, when we talked about earlier, gives a lot of flexibility for an employer to get benefits to those who best deserve it. Some disadvantages, let's take a look at the disadvantages, defined benefits first. First, we need a steady cash flow, and that is a problem for any small company, any large company. I guess Microsoft doesn't have a big cash flow problem, and I would guess Yahoo and Google, some of these, but in general, companies all have cash flow problems. They're all borrowing. You see that on the money market funds, and because that's all money, short-term loans. And if you're a small business, you're desperate for cash flow issues. And one of the reasons I have discouraged some people from having a retirement plan at the price, because the cash flow is very volatile. And if they therefore want one, it's got to be the profit sharing plan, or one where the employees make all the contributions. Employers who are not lifers obtain little benefit, and because again, the key is how much money you're making in most cases, how old you are in most cases, and how long you've been with the company. And basically, until you're 65 or 59, whatever is the retirement date that the company has, there's very little that's going to be vested to the employee, because the whole purpose is you stay till retirement. It's expensive administration, and I think when we talk about the individual who has his own little company and he has a high turnover employee, so the only one who really benefits is himself, he's got to realize there's a big expense involved administratively that he's going to incur. And again, when I say big, it's relative. There are simpler ways and there are complex ways. Unfortunately, most people want all the bells and whistles, and it becomes the complicated one, and that becomes very expensive. Let's take a look at the disadvantages of defined contribution plans. You can't set aside as much yearly contributions as under defined benefits, but still, in theory, it's an indexed amount today is about $50,000 and a year, which is again much more than anybody can contribute. And now you're limited to 25% of your income. So if someone's making $200,000 approximately a year, they could take out 50, but I don't know anybody can afford that. People more or less can take out 10 or 20,000, even if they could take out 50,000. People's budgets are too tight today. People are a little bit nervous about the economy. Second, it lacks retention power for employees once they vest. Once they vest, they can leave, and a lot of people do leave after vesting. And I know several times people come to me and they were with the company, and they were with the company 4 years or 3 years, and I say, why don't you just wait a little bit longer, stick it out, because then you're going to vest 100% when you reach the 6th year. So they stay the extra year or two, and that also gives them time also to think about what they really want to do. They know they're going to leave in 2 years, but what are they going to do? And that sometimes finds that they find they're best staying where they are. And then the employee takes the risk, which can be a disadvantage of the employee, but for employer it isn't. And I've always said we should really separate the advantages and disadvantages for the employer versus the employee, because they're not the same in most cases. However, I never sit down and do that. Plan administration. This is more a boring part of the whole topics of the subject for many people, but it's again where a lot of financial planners make their money if they're also enrolled agents or retirement plan enrolled agents. And this is because of the ERISA Act. This 1974 law sets forth the rules for qualified plans covering retirement income. Some non-qualified plans are also affected. I might note that probably in 1974, yes, we had plans. Yes, indeed, there were ways that you could get tax advantages, etc. But the rules regarding the funding and the management involvement by the IRS first came about in 1974. Up until 1974, it was the Wild Wild West. And I think one of the things that triggered it is in 1971 or 2, Lockheed Corporation, which was the biggest employer in California at the time, could not finance, without borrowing money, the payments for the retirees. They had nothing that's really saved up. It was a period of high inflation, and they had a big financial loss on the C-5A aircraft they were building, or in developing the design, etc., as well as the initial builds. So money was extremely tight for them. They found it difficult to borrow money. They were actually threatened to go under financially, but they were bailed out. So that probably was the biggest impact, because people at the first time really realized what could happen. Your retirement plan may not be there even with a big company. And I certainly later on today, in the last few years, we found out with General Motors, where in the late 90s, 2008, 2007, they basically were unable to make these payments. So there are some coverages. The primary goal of the ERISA Act was to prevent discrimination in favor of highly compensated employees, which is, again, something that was very prevalent prior to the 74. It seemed that the only one who had retirement plan money coming in was the highly compensated. Provided vesting schedules and required adequate funding of the plan. And adequate funding doesn't mean full funding of the plan if it's a pension plan. It does for defined contribution plans. It does not for defined benefit plans. The IRS role under ERISA. New plans must be submitted to the IRS for approval. This is done typically through an attorney, a CPA, an enrolled agent, or retirement plan enrolled agents, and they are the ones who are able to communicate with the IRS. Sometimes larger companies have employees within the house that specialize in dealing with the IRS on this, and then you can use your company employee to do it. But most companies today have been using these outsiders who are specialists who know how to deal with the government. I actually think it's a great move for financial planners who do insurance sales to get involved with being enrolled retirement plan agent, because that can be used to get them into small companies, and not only are you doing the retirement plans for them, but it gives you the control over their insurances. And I've known several people who were my ex-students who did this, and in many cases they earned a substantial amount of money from doing the IRS activities, because the rate per hour is very high. It requires you to pass a test issued by the IRS, and that test is basically information covered in this class. You take this class plus study a few weekends, you should have no difficulty in passing the enrolled retirement plan agent exam. The IRS does monitor your existing plans, and that's, again, you need somebody to represent the company, and that, again, is an opportunity for those retirement plan specialists, especially if you're a financial planner too, that are dealing with insurance and other needs of the company. And the IRS interprets the laws and issues regulations, so you got to keep up to date on what they're doing. And the IRS works very closely with enrolled agents because they know that they're the ones who are going to make the system work. Unfortunately, there are companies who try doing it on their own and have a disaster. Pension Benefit Guarantee Corporation under ERISA, when it first came out, the headlines were saying pension plans are guaranteed by the U.S. government, and I think they even said retirement plans are, but it was what most people got out of it when it first came out was that if you had a retirement plan, you were guaranteed getting your money, and that is not true at all. Once the details came out, we found out that it's very little coverage, and it only applies for pension plans, not for defined contribution plans. The way it's operated is the Pension Benefit Guarantee Corporation gets money from the employers who have defined benefit plans, and that money is used so if a plan goes under, the employees get something, and it's usually nickels on the dollar. If the plan is underfunded, the board or corporation rather may mandate that it be terminated and can assess the surplus of the corporation up to 30% of its net value. So, and there are times where this has happened. When someone said, why 30%? Well, I think the government has decided if we did 100%, we'd wipe out the company, and probably even 50%, but they said the company could survive if 30% of its net worth was used for the retirement plan, and also is a nice threat to keep companies aware that they do have to keep it funded, because if you don't, you could wind up having up to 30% of your money taken by the government. Department of Labor has a big role, but not visible to the companies that much. They police rather the investment plan assets, which is typically they're looking at the trustee, or which might be a brokerage house or a trust company or Schwab, etc., rather than the company. And they look at the action of those administering the plans. I've never been approached by the Department of Labor or anything. The only one I've ever dealt with, quite honestly, is the IRS. They work with the IRS in oversight of prohibited transactions and issue regulations to implement the law. Who is a plan fiduciary? Anyone who exercises any discretionary authority or control over the management of the plan, exercises any authority or control over the management or disposition of the assets, offers investment advice for a fee or other compensation with respect to the plan, has any discretionary authority or responsibility in the plan's administration. Those are a lot of people who have a fiduciary responsibility to the plan. And sometimes people are doing something, for example, administrating a plan, or have some kind of control over the assets in a plan, or disposition of the assets as an advisor, and all of a sudden they find themselves in a fiduciary relationship. And I think that probably the most important thing for you to remember is that for you and your clients, that they should not be getting themselves in this position unless, again, they know what they're doing and they know the risks they're getting into. Who is this qualified party and a parties in interest? In other words, who cannot deal with the assets of the plan? Plan fiduciary, which is the previous chart, any person or organization providing services to the plan, and any employer or employee organization that has a plan, an owner, director, and indirector, 50% or more of the employer, members of the family of any person listed in 1 of 4 above. Now again, the question is what family is, and families in the IRS has different meanings depending on how it's being used, and it could be anything from just the children, spouse, and parents to siblings and nephews and nieces, etc., and in-laws, so you have to be careful on how it's being used. And I haven't looked it up for a long time, so I don't want to make a comment other than it tends to be very broad. A corporation, partnership, estate, or trust that is 50% or more owned by someone listed in 1 to 4 above. An officer, director, 10% or more shareholder, highly compensated employee earning at least 10% of the total employer payroll, or 10% or more partner or a joint venture of a party listed in 3, 4, 6. And this basically covers obviously small companies. Too many companies where someone owns 10% of the shares, and it's large. For example, Bill Gates, I think, only owns 3% of Microsoft. So this tends to small companies, and the problems come from the small companies. Let's face it, the large companies do train their people, they have lawyers giving advice all the time. It's the smaller companies that run into problems in these areas. And the best way is to advise your clients that if they're involved at all with the retirement plan, they really need to do their due diligence to find out exactly what the responsibilities and rights are. And I think one of the results is most of them will not want to have anything to do with the retirement plan. Prohibited transactions. What are prohibited transactions? This sale, new spelling the word sale, isn't it? Exchange or leasing a property with the plan, lending of money or extending credit to the plan, furnishing goods, services, or facilities. And in fact, the owner of the company who has the plan cannot give us facilities or equipment, etc., used by the plan without compensation. And that's what that's really getting to. Transfer to or use of plan assets by a fiduciary or disqualified person. Plan fiduciaries dealing with plan income or plan assets for their own interest. Receiving consideration for his or her own account from a part in a plan transaction which involve plan's income or assets. I've had people tell me that retirement plans cannot own assets in the plan of the company that has the plan. That is not true. There are certain restrictions for defined benefit plans as to how much you can have a company stock, because again they're worried about diversification. But things like profits sharing plans and stock bonus plans, they use the only stock of the company. So that would not be a true statement. The ownership of stock is a different aspect, different situation. Penalties assessed with prohibited transactions. There's a penalty of 15% of the amount involved, and it's imposed each year until the transaction is corrected, deficiency notice is mailed, or the tax is assessed, whatever occurs first. An additional 100% is imposed if the transaction is not corrected within the required time period. Several times I've been involved with dealing with clients where they were not paying attention, and they get the letter from HR would get the letter usually from the IRS, and they kind of ignored it or stuck it in their file because they didn't understand it, and all of a sudden 100 taxes involved. And I think it's a matter of companies having their mailroom and HR departments being aware of what they should do with this information. In some cases it goes to the controller, some cases it goes to your attorney or outside counsel, sometimes it would go to whoever. But you got to have instructions for your mailroom and your HR department if you want to avoid problems, because too often if they don't understand it, it just goes in the bottom of the in basket. Exemptions from liability. How can we avoid liability, which is probably to me the most important. And if you're receiving benefits under the plan terms, you're not going to be liable for doing that. Distribution plan assets in accordance with the plan, you're not going to be liable. Making non-discriminated loans to participants, loaning funds to an ESOP, purchasing or selling employer securities for an individual account plan, providing office space or services plan for reasonable compensation. Now that gets back to earlier what you can't do, because you can't do it for free, but you can charge reasonable compensation for the office space or services provided by the company for the retirement plan. And typically it's a small office and they need a computer and a phone, etc., and you charge them a reasonable compensation. Providing qualified investment advice to plan participants and beneficiaries. All of these are exemptions from liability. In other words, you're not going to be liable if you follow these rules exactly. But if you deviate, that's where you run into problems. Pension plan reporting. The most important reportings are summary plan description, the annual report, summary annual report, which goes to the employees, individual plan statements, and again, a lot of companies don't realize they're getting themselves in all this administration when they set up a retirement plan. And I think it's the duty of you advising them that there is going to be a significant expense. Again, significant depends on what's going to be done, what their plan is. Did they have, I always say we should have a KISS plan, keep it simple, stupid plan, but a lot of companies want to make it more complex. And again, this is for pension plans, not retirement plans, but I again suggest you use the templates from provided from the sources I gave you earlier in the course. Summary plan description. Report plan to participants within 120 days after a plan is established, describing what is in the plan. Contents are described by the Department of Labor, who very rarely gets a copy. They don't really want a copy. In fact, you could probably irritate them by saying a copy. However, they have the right to review it, as does the IRS, to make sure it does describe what is actually in the plan. Sometimes you get somebody wordsmithing it or trying to make it look nicer, etc., and they change the meaning from what's in the plan to what's in this summary plan description. And I've had that several cases of problems where people thought they were getting something they weren't, and they did an action accordingly. It didn't come through, so they sued. Actually, what they did is they went to the Department of Labor or IRS, and then we had to clean it up. The annual report, the 5500, is filed with the IRS within 7 months after the plan's year end. There's many exhibits, and sometimes people say, well, it's just a government form. Again, it is very comprehensive. It requires a lot of time on the part of the company, and that's why you get 7 months after the end of the plan's year to do it, get it submitted. And you better submit it on time. That's the only thing I can say. Again, this is an additional requirement, and we've gone over this in some of the retirement plans. We talked about this form for almost everything. Summary annual report provided to participants within 9 months after the end of the plan year. It summarizes Form 5500. Again, we've run into problems again. The information is taken from this legalistic document that we have submitted to the government, and we now have on Form 5500, and it's summarizing it so our employees can understand it. And sometimes, again, the meaning gets changed, so you have to be very careful. I would certainly have a lawyer get involved in this, not just the HR department. Individual benefit statements for defined benefit plans. If requested by a participant, a statement of his or her benefits under the plan must be provided in 30 days. Actually, I find that when I talk to people in the field, very rarely does anybody ever ask for it. But if they do, they get it in 30 days. It's not a big deal. Now, for defined contribution plans, with a direct investment feature, provide statements at least once a quarter. Many companies do it monthly. In fact, a lot of companies today allow you to go online 10 times a day if you want to take a look at where you stand, which is kind of interesting. I tell my clients not to do that. I say that if you have a retirement plan or even an investment plan, you ought to take a look at it once a month or so, but when you do it too often, you don't see the big picture. You see the day in and day out little changes. You want to do it, of course, once a month or once a quarter, because the conditions may change in a company or in the market or within an industry. Plans without directed investment feature provide statements annually and as requested by a participant. And again, from talking to other people, very rarely does a participant ever ask for it. The directed investment feature is the one I like. I think that's the best way. And